first of all, thank you everybody for being on. If you've been with us before, same structure here. If you have questions or if there's something you would like me or Tim to answer through the presentation, please feel free to drop those into the question area. Ryan and or Tim or myself will be able to take those questions and either we'll hold them for the end or we'll try to answer them as it's relevant during the presentation itself. But, our real goal here with Balance and the reason that we're trying to do a lot of these webinars is to keep things simple, explainable, and aligned with your values. So Nick says this a lot when he's talking about our investments and our investment conversations. And I think Tim is really trying to do the same thing today as we talk through long-term care, understanding what is out there, how potentially we can pay for it, but also just simplifying it down to really understanding the core concepts themselves and allowing you to get a feel or an understanding if it may be appropriate or not, depending on your situation. So we're going to go through a quick introduction for Tim, then what is long-term care, what are the costs, and then really the meat is going to be in ways to utilize insurance. We'll go through some comparisons and case studies and have time for questions at the end. So we're going to try to, again, keep it kind of short and sweet and really be here to answer questions as they may come up. So please just put them out there as you see things or as you have questions. But we're going to let Tim run with the conversation today. Tim is one of our team members down in Austin, Texas. Tim Power, he's been in the business for 25 plus years, I believe, at this point now, or going on 25 years. Spent a lot of time with New York Life and different insurance organizations, and he has a really strong background and he really enjoys the insurance side of things, right? Like understanding what our needs are, how we can protect them, and utilizing insurance in smart ways to protect your biggest risks. So I'm really excited to be able to let him talk and do his thing because he's really great at it. And as we go through this, again, please ask questions, make sure that you're, letting us know if there's something you want us to expand upon, and we'll go from there. So without further ado, I'm going to let Tim take it over and go from there.
Awesome. Thanks, Bob, for the great words. Yeah, thanks everyone for joining tonight. It's an exciting conversation, long-term care. I'm sure you could find other things to do than to learn about long-term care tonight, but we appreciate everyone. It's a very important part of your plan. So tonight we're just going to briefly talk about what long-term care is, and then what are the costs, way to use insurance, and then we'll look at a couple comparisons if we have time. So long-term care, what is it? I mean, it's really extended custodial care for chronic illness or disability, and it's after Medicare and it's before Medicaid. So a lot of folks have this misconception that Medicare is going to cover my long-term care, and it really doesn't. And so, but extended custodial care is a much better way to say long-term care. I think long-term care is one of those catch-all phrases that are just kind of out of our vernacular as far as the reality of it. But if anyone on this call has been a caretaker before, you know how critical this planning can be. And you also know without a long-term care plan in place, the loved one's spouse and the children become your long-term care plan. And so I know Bob and I were chatting quite a bit preparing for this, and we're not trying to scare anybody tonight. We're not trying to freak anybody out. We're going to share some statistics. We're going to share some numbers. We're going to talk through some situations, but we're not trying to scare you into buying insurance or anything like that. Most people on this call are our clients. We already know you, you know us, but it is an extremely important part of your planning conversation. And so we want to really help you understand what it is so that you can prepare for it. We can go to the next
Mhm.
slide.
Okay.
And where is long-term care provided? It's mostly in the home. 73% of long-term care is provided in the home. And so again, this is care after Medicare. So let's say you get really sick, you have a stroke or something, you're going to go into the hospital to get help. That's Medicare, hospital care, and preventative care is Medicare. So getting mammograms and colonoscopies, that's covered by Medicare. It's really hospital and just health insurance like you've had your whole life. But after 100 days of being on Medicare as a stroke survivor, you're going to go home. They literally will kick you out and you will go home or to an assisted living facility to get more care to continue to recover. And most of the care is done in home. And you can see the
Mhm.
pricing here. The average, these are averages on Care Scout. And we'll look at that in one second, but it's about 6 grand a month to have home care services there. And assisted living is a little less, and nursing home facility is even more. For a semi-private room, you're talking almost 9 grand a month for a private room,
Mhm.
almost 10,000 a month. So quite a big expense there that could happen. And if you want to click on that link down there, Bob,
Yeah.
this was just a
Well,
resource
and
that
one
you
thing I
can
just
all
want to
look
say
at.
really quick that
Yeah,
I
please.
was really interested in because Tim brought this up and Tim put this together. And when I saw this, that 73% of long-term care is provided in the home, it just was surprising to me because I think we all just kind of go to, hey, long-term care is when, grandma needs to go to some facility or something like that. But really, it seems that the statistics say that most of the time, if you're getting care, you're getting it in the home. And especially if you're married, right? And you have, husband, wife, that kind of thing. So it's just really interesting to see the different percentages as far as where care takes place.
Yeah, it's wild. If you want to click that,
Yep.
this is a pretty cool
So
resource. Yeah, if
let
anyone
me
wants
pull
to
it in.
check. Yep.
Yep. Here we
Um,
go.
and go down before you put in a location, scroll down there, and that shows the median cost across the US. So that's where I got those numbers from. And you can see just what it costs to in-home care versus assisted living versus nursing home. But then we can go and look at how radical it changes. So, Bob, you want to put in, I don't know, Colorado and Ohio or something? You want to try?
Okay.
We'll do,
Just try Colorado and compare it to, well, I think just
yeah,
really
you can
quick,
do
what
that.
you can use this for is you can just say, oh, I clicked Wyoming. They're both big squares or rectangles, right?
Yeah.
So, um, but Colorado here, and you can see how the numbers change depending on Colorado versus if we, go back and we pick Ohio, right? A little bit more expensive for community and assisted living in Ohio than it is in, say,
Yeah,
Connecticut, right? It's going to
Massachusetts is
be
crazy.
Massachusetts, right? And this is a really helpful tool that Tim was sharing with me that we could say, okay, well, if you're in Ohio and you're in Colorado, what the different prices are depending on where you're at.
Yeah. And so that just gives you a baseline of what the costs are, right? Because when we're looking to insure this risk, we have to start somewhere. And we usually start with a monthly amount. Okay. You can look at the annual, Bob. Will you click annual too, just to show like these are real numbers, 64,000 a year, to take care of you in a home. It's quite a bit, right? That's the potential out-of-pocket expenditure. And again, we're going to talk about insuring this risk, but what we've found being in this industry so long is the people that don't have insurance, they end up having to spend this out of pocket, but they also are they're more reluctant to spend their money on themselves. So we'll
Mhm.
talk through that a little bit, but it's really interesting to see people that don't have policies, they tend to skimp on themselves and not want to spend their money. We'll get back to that later.
Yeah, and I thought this was cool too. You can kind of go and you can say, hey, how far out am I projecting, what costs are going to be at some point in the future. So everybody, this will be in both the presentation that we send out and then also in the follow-up email. So you can go through and use this to get a sense for where you're at and what the cost may be.
Yeah, it's a great little
Okay.
tool. There's a lot of tools out there for this kind of stuff.
Yep.
Yeah, you could go to the next slide.
Okay.
And so these are some statistics, and I like to quote Yogi Berra here. Yogi Berra once said, "If your left leg is in a bucket of ice and your right leg is in a fire, a bunch of coals, on average, you're pretty comfortable." So, statistics are, in other words, statistics are, we can make them say anything, okay? But there are some good stats here. 70% of every 65-year-old today, 70%, two-thirds are going to have some sort of long-term care event in their lifetime. How do they know that, right? There's so much data. Data is the new gold, they're saying. Data is the new oil. There's so much data that they've compiled, these insurance companies over the years. That's all this is. It's just math, actuarial tables, and they're projecting out based on all the hospital visits and care outcomes. They have really good stats now. 20% of those 65-year-olds will need care for longer than 5 years. All right. So it's a numbers game. You could be the one third that's not going to have a long-term care event, and that's awesome. But there's two thirds that are going to have something happen here coming down the pike. 72% increase in the top right corner there, 72% increase of long-term care insurance for those 65-year-olds who wait 10 years to purchase a long-term care policy. $14 billion was paid out in claims in 2023 for long-term care. So these companies, they do pay. They will pay these claims. About 3 million long-term care policies out there since in 2023. That's just traditional long-term care. That is not including the hybrid policies, which we really feel are some of the best bangs for your buck, if you will. And 64% of long-term care claims paid out were for women. And
Yep.
we're going to chat about that a little bit. Women, they live longer than men. And, why do men die before women? They want to. No, I'm kidding. I had to have a joke. But no, women are going to outlive men for the most part. Yeah, that's great. You can go there. And they're going to need this care more likely in the future. Oftentimes, women are taking care of the husband and they burn themselves out, and then the husband's gone, and now the wife is alive without, any
Mhm.
caretakers for her. So that's just something that can happen. And so when we talk about long-term care, you're really talking about your daily activities.
Yeah, and
Everything you
Tim,
did. Yeah, go
Tim,
ahead,
just
please.
to
Sorry.
cut in, we had a
Yep.
question come up from somebody that said, "Could you clarify a long-term care quote unquote event?" And so that's why I
Yeah.
pulled up this slide so that you
Perfect.
could tie
Yeah.
straight into what does it mean to need long-term care?
Yep, exactly. Great segue. So, long-term care it's really an event. Okay, it's not just this nebulous thing. Long-term care is an event where you are no longer able to function normally. Okay, so all the things you did to get on this call today, you woke up this morning, you made coffee, you went out, you did errands, you got food, you told your wife you love her, you got her flowers, all those things you can't do anymore. And a long-term care event kicks in when you cannot perform two of the six activities of daily living. So you can no longer dress yourself. You can't make food for yourself anymore. You can't transfer in and out of bed. You can't go to the bathroom without assistance. You can't take a shower. You can't remain continent. So you need help with some of these things. So when two of these six are you're unable to do, that technically triggers a long-term care event, and that's when like an insurance policy would kick in at that point. Or outside of these six ADLs, they call them, activities of daily living, it's also cognitive. So you have a severe cognitive impairment, Alzheimer's, Parkinson's, something like that, and the doctor has to agree that you are unable to perform these activities anymore, and then they'll go ahead and allow the plan to pay out and all those kind of things.
Yes,
Any
and Tim,
questions around
that's
that, Bob? Yeah.
yeah, Tim, that was exactly what the next question that came up was how is that determined or diagnosed? And it needs to be from a doctor. So a doctor needs to say, hey, Jim, so and so cannot perform two of the six activities. He can't feed himself. He can't get himself from bed to chair to wheelchair, whatever it may be. And because a doctor has said he cannot do at least two of the six activities of daily living, he is then in need of long-term care services. And it could be more than two out of six. It doesn't need to be only
Yeah.
two out of six, right? It could be all six that you can't do.
Yep.
It could be, to Tim's point, it could be a cognitive impairment. So Alzheimer's is the most common one that we all think of. And I think if we go back to this 20% of 65 may need it for longer than 5 years, that almost every time is Alzheimer's, right? That is the
Mm-hmm.
when body is still there, the body is still functioning, but the capabilities, the mental capabilities are going. That is, that longer term sort of thing. But great question from, the crowd here in just understanding what long-term care is, what it means, that actual event. And yes, it needs to be diagnosed by a doctor.
That's right.
Yep.
So I guess we could jump right into the next slide here, Bob, and talk through this. So when we talk about insurance here at Balance Wealth, I mean, we really look at it like an asset class. And what do I mean by that? In your portfolio right now, you have stocks, bonds, real estate. And I love this quote: concentration makes you rich, diversification keeps you rich, right? So, concentration risk is when you put all your eggs in one basket, your company for 40 years, you worked really hard. That was your genius and you saved a bunch of money. But as that money comes in, you want to diversify it, right? That's what keeps your assets growing and not losing money if when all your eggs aren't in the basket. Insurance, we look at just like an asset class because you can invest into it and you can get a return, really. Insurance offers things that stocks, bonds, real estate, cash, they don't offer. Insurance offers guarantees, right? As good as Bob and Nick are at managing the portfolios for everyone, one thing they really can't do by law is guarantee future performance off of past results, right? We say it all the time. It's but with insurance companies in the contract, they're actually adding guarantees. And so when
Hmm.
you include insurance into a portfolio, we see it all the time. Our clients that have this kind of insurance, or really all types of insurance, but specific intentional insurance, when it's part of their plan, it allows them a lot more peace of mind to not get as nervous when things go up and down because they know they have this coverage that's going to be there for them. Even if they spend all their money on living, they're going to have this nice
Hmm.
policy to pay out for the care. Bob, do you have some
Yeah, I
thoughts on
think
that?
yeah, I think that's a great point, Tim, right? The fact that as our a lot of our job or a lot of our position for our client is like, are you going to be able to retire and maintain the lifestyle that you want and ultimately not be a burden to your children, right? Like I can't tell you how often we hear that. I understand that with my three kids, right? Like I never want to be a burden to them. And for when we have insurance, and it doesn't need to be, and this is where we'll get the next slide is ways to pay for long-term care, and we'll start to talk about the different ways we can do that. I think so often with long-term care insurance, it's just been focused on one of those six areas, right? Which is just the traditional long-term care. So I'm excited for Tim to talk a little bit more because if for those folks that have it, that have that peace of mind that they know, hey, my long-term care needs are maybe not fully covered, but at least there's something to protect me. It gives us way more ability to be able to enjoy our money, enjoy our resources, enjoy our family because we're not worried as much about being a burden.
Yeah, before you go to that next slide too, one last little thing I'll say, and this isn't, I don't mean to make generalizations, but again, we do see this when we're doing our client meetings and we incorporate this type of insurance into someone's portfolio. I mean, Bob, tell me if I'm wrong, but oftentimes they're able to then take on a little bit more, say, stock market exposure than they would otherwise because they're in a 50-50 or 60-40 portfolio without the insurance because they're afraid they can't lose that money because it has
Hmm.
to be there, right? And then all of a sudden they get this peace of mind. They're like, wait a second, I know things are covered. Why don't we ramp it up to a 70-30? Again, this isn't investment advice on this call, but we see that happen oftentimes. It just gives them
Yes.
that little stability. And then that gets higher rates of return. And so, again, that might sound a little salesy or whatever, but I just feel like that's something we notice.
Yes, absolutely. Right. It allows us to change the portfolio to take that into account. So this next one, I'll let you kind of go through each of these six sections. So, and just kind
Sure.
of touch on each one a little bit to what they are. But then what Tim's going to do is then we have slides for each of these that goes into kind of the pros and cons of them across the board.
Yeah, that's great. So there's really six main ways you can pay for long-term care. And we're going to briefly go over these. So there's self-pay in the top left, and that's just you allocating a certain amount of money towards this potential risk. People call it self-insure, and that is a misnomer because insurance by definition is pooling risk with multiple parties. And so if you're not self-insuring this risk, if you're self-paying it. You're retaining the risk. Yeah, Bob, were you gonna say something?
No,
Oh,
I'm
okay.
smiling. It's a fun way to put it.
Yeah. So yeah, you're really paying out of pocket, and so we'll talk about that. And then if you go down the bottom left, Medicare, Medicaid. Again, this is picks up where Medicare leaves off, and it's you have to spend all your assets to qualify for Medicaid. Originally, long-term care insurance back in the late 70s, early 80s, it was put out as nursing home insurance because Medicare doesn't cover nursing home. So these brilliant people at insurance companies said, "Oh, let's make some money off nursing home insurance." Guess how many people on this call want to go to a nursing home? Right. Zero. Okay. So, but the benefits started paying out for home care, and they realized, oh, wow, there's actually a bigger opportunity for people to stay home. They don't want to go to a facility. They want to stay in their home. So now it's really insurance to keep you in your home, not insurance to go to a assisted living thing. That hopefully that made sense. Top, middle, traditional long-term care insurance. That's what Bob was mentioning. That's what a lot of folks know about. They hear nightmares that it's too expensive. The premiums went up, 180% since my grandmother bought it or since we bought it. And so, there's some things we'll talk about that. Underneath hybrid long-term care insurance on the middle bottom. And that's really linking a few different products into one plan. So maybe life insurance, annuities with long-term care all in one. And the top right, life insurance with living benefits. We're not really going to touch upon this one much, but it's basically buying a life insurance policy and including a long-term care or a chronic care rider in the plan. And again, we're not going to spend much time on that. Those are okay for specific situations. And then short-term care. This is something that's been out for a few years. We're going to talk more about this in a bit, but I personally believe short-term care is one of the best things since gluten-free bread. So,
All
so
right.
yeah,
Well, we'll
on the
go
next one,
into
we have an example, I think, right? Or is that yet?
uh
No,
no,
self-pay.
the
Okay.
example will be after the hybrid, but we'll start. You can just
Okay.
kind of start with the self-pay and we'll go from there. And
Yeah. So
again,
the pros,
folks, if you have
yep.
any questions or anything, people just go ahead and pop them in and we'll do our best to answer.
Yeah. So, the pros of self-pay is there's no out-of-pocket expenses. You can grow your money more than the insurance companies. Like, again, without guaranteeing the future, I'm positive that we can grow your portfolio much better than 3% over the long run here at Balance Wealth. I can, yeah. So, but it could also go down on your portfolio. And the considerations are with self-pay, or sorry, on the cons, that you're reluctant to use those funds for yourself when you know you have to live off those. There's no tax advantages to using those funds. Most people's retirements are in IRAs. They're in qualified funds. So if all of a sudden at 86 you have a long-term care event and you still have 800,000 in your IRA at that point or 5 million in the IRA, you start taking that money out, you're going to be taxed every time you take that out at that point. And another big point is just the distribution risk. If you're taking money out for long-term care at a time where the stock market goes down 10, 20, 40%, you're risking lowering your overall portfolio by quite a bit, taking money during a bad time in the market. And then family becomes your caretakers. So if you're going to self-pay, I would get in writing from your spouse and children that they're okay with taking care of you if something happens. I don't mean to laugh about that. I mean, everyone on this call, I've had personal experience with caretaking. My dad had a stroke 6 years ago and unfortunately did not have long-term care. And I can just tell you 6 years in, it's just kind of an ongoing challenging situation. I'll leave it at that. The whole family is my dad's long-term care plan. So yeah, considerations, like I said, discuss with spouse and children. Now, have a plan. As long as you're being intentional about this, and this is actually your plan, I'd make sure to update your estate planning documents. That's something you should be doing anyway. Make sure the medical and the financial power of attorneys are updated because if something does happen, it happens quick. It can happen quick, and you need to make sure everyone is ready to go to help out with what you can't do yourself anymore. Did I miss anything, Bob?
Yep.
I know I kind of go all over the place.
Nope.
Okay.
No.
All right. Medicaid, the pros, it covers pretty much all your long-term care costs. And about 44% of all long-term care costs come from Medicaid right now, if you can believe that. The cons, you have to have less than $2,000 in assets to qualify. Now, there is a spousal amount. They can have 156K, but you can't have more than 2,900 of income. So it really is for the impoverished. It is a social welfare program funded by both state and federal government, and the benefits are really there for like a last resort. When you go on Medicaid, if when I'm here in Austin, if a bed opens in San Antonio, that's where your loved one is going. Like they go wherever there's a bed, and these days there's a lot of people using these services. So it's just it really is a last resort, and I wouldn't count on that. Yeah,
Yeah,
and you can
and
do some
Tim, I'll just
Medicaid
say, I
planning, Bob.
know.
You're gonna say, yeah.
Yeah, I mean, you could do Medicaid planning, and there are ways to, set up trusts to get assets out. And this is a very attorneys like to talk a lot about this, right? Because they can set up, like trust planning or whatever. But at the end
Mm-hmm.
of the day, the thing I don't like about Medicaid is it loses the control, right? Like you don't have that choice. So even if you get to a point where you transfer assets out and you're not subject to the Medicaid spend down of, that kind of 5 year look back, it's like, do you really want to be in a place where Medicaid sends you? And maybe yes, right? Because hey, let Uncle Sam take care of me so that my kids don't have to. But to that extent, I think this is kind of to your point, you basically have to be out of money in order to qualify for Medicaid.
Yeah, that's right.
Okay.
All right, so traditional long-term care insurance, the pros, there's some tax benefits, the tax-free benefits. The money goes into long-term care policies after tax for the most part. So you're going to pay taxes, and then you'll pay the premium. So the benefits come out tax-free almost across the board. There's really no exception to that. There's great care coordination. It pays in-home or at a facility. Um, the real big cons with this is if you don't use it, you lose it. That is primarily the number one thing. People, first of all, don't want to spend money on something they think they're never going to use. And just to stay alive in our heads, none of us think we're going to ever need long-term care, because why would we think those kind of thoughts, right? But we know that it happens. So with traditional long-term care, if you put 100 grand in over your lifetime, and you don't use those benefits, they're gone. Similar to auto insurance, right? You're glad you had it if anything happened, but at the end of the year, you spent 3, 5, 6 grand and nothing happened. You lose all that money. So, and there's a risk of premium costs rising. You might get in at 62 years old, 3 grand a year, and now all of a sudden you're 86, and that premium goes up to 8,200 a year, and you're stuck with this bad situation with, should I keep paying this or should I drop it? And we've seen people drop it, not personally in our client, but we've seen stories of people dropping it and then having an incident soon after they drop their long-term care. So
Yep.
and there's no 1035 option. We'll talk about that in the next grouping, but you really do have to pay these just straight up with taxable money. And
Yep.
so the consideration, the earlier the better. The younger, like you're as healthy and young as you are will ever be today. You may get more healthy, but you're not getting younger, right? So the younger you get it, the least cost it is, and the more healthy you are, the better chance you're going to get approved. I had a 69-year-old guy get approved last year, and his 56-year-old wife got declined. It's the first long-term care decline I've ever had. Like, we don't have any long-term care declines because we do a lot of back work before we apply to make sure that you're going to get approved. And this girl got declined because she
Mm.
had some enzyme thing that made her look worse than she was. So we're working on it, but it just was very surprising. So yeah, strict underwriting can be there, and I thought she'd get approved. Her 69-year-old husband got approved, but she didn't.
Yeah, and
Okay.
this is the main one that everybody knows about, like paying a monthly annual premium, whatever it is. And the big thing is if you don't use it, you lose it. So the next one is hybrid long-term care, and it's utilizing kind of what are called linked benefit products. And this is really nice because it eliminates that if you don't use it, you lose it kind of thing, but it doesn't leverage up your dollars quite as much. So Tim, I'll let you go through this one, and then we have an
Yeah.
example for this one.
Yeah. So, as Bob was alluding to, traditional long term care, you do typically get the most actual long term care for the dollars you put in. And however, these hybrid policies have really listened to the market, and they've come out with very competitive pricing that actually rivals pretty close to what you get dollar for dollar for a regular long-term care plan. The beauty of these plans is you're allowed to use, in some situations, IRA money to fund the policies. And you can actually use IRA money, individual retirement account, as an individual, and you can include a spouse on it, believe it or not. And there's a whole magical way some of these companies do that. And I won't get too into the weeds with that. But, oftentimes there's 0 day elimination period for home care. I didn't talk about that in the last slide, but there is what's called an elimination period to get these benefits. So if 2 of your 6 ADLs are compromised, the doctor says, yes, you cannot function. You have to actually wait 90 days on most long-term care plans. You can do a shorter elimination period, you can do a longer one, but 90 days, 3 months is the typical one before the benefits will kick in. And on a lot of these hybrid plans, they'll waive the first day if the care is in the home. So that's pretty
Hmm.
huge. And there's some really good options for people that thought they were uninsurable. There's an annuity care option, and the underwriting is literally 4 questions to get approved. And so it's a lot easier to get people approved these days if this is
Hmm.
something they're looking to do.
Yeah,
Yeah, I
and
think that's
and
probably it.
most of these are also underwritten, for the ones that provide the most benefit. The annuity option that Tim just alluded to is effectively not underwritten. It just has some qualification questions, but they don't actually go in and like pull medical records or anything like that. So these can be great options, and they again, the benefit here is that they offer a few benefits and really offers leverage for those that have quote unquote elected to self-pay. So if you don't mind, Tim, I'll just kind of walk through the example
Yeah,
really quick and
it's
then
great.
let you pick back up with the life insurance with living benefits. Um, but I just wanted to throw this out there to kind of explain the concept a little bit clearer, I guess. So just using an example of a married couple, 66 and 60, they're in good health, 1.6 million in assets, and they have 200,000 sort of earmarked for long-term care, right? Like this is a very common setup that we see with a lot of our clients and a lot of the people in kind of the situation that we're looking at now. And to go back and steal Tim's pie chart idea, this is kind of that setup, right? It's like, okay, we've got our fixed income portion, our long-term care earmark portion, and our equities portion. And the way hybrid long-term care insurance works is it sort of takes this earmarked portion, this $200,000, and it sends it over to the insurance company for a long-term care hybrid insurance company. And what you end up getting from that $200,000 is effectively just leverage, right? Like it makes the dollars go further and also on a tax-free basis. So that 200,000, and this is a real quote that we pulled from a client looking at this, would offer day one $630,000 of long-term care benefits, which is about 6,600 per month for 6 years. Um, with inflation protection, that's $1 million of tax-free long-term care benefit by age 80, so over the next 14 years. If they never use it, so if this spouse couple never uses any dollar of long-term care and they pass away, 239,000 goes tax-free to their beneficiaries. And kind of looking forward, if they ever decided just to cancel it and say, I don't want it anymore, there is a portion that they can get back over time. I think by year 30, it's like you can get all the money back. But by year 20, it's about 80% that you get returned. And the idea here is that you're taking an asset that you already had earmarked for long-term care and leveraging up without sort of the whole notion if you don't use it, you lose it. So I really like these options for folks, and think that this is a really great example of, again, Tim, to your point, the market listening to what folks cared about when it came to long-term care.
Yeah, it's a great slide. And I know we're going through a ton of stuff. We've been looking at these slides and all this information for a long time. So there's no dumb questions if anyone asks anything. I know there was a question in there. I wasn't fully understanding Brad's question there about 13K total. Is that for home? So in-home
Oh, that
total?
was back to the examples
Got
of
it.
the when we were on the website. So
Okay.
we
Oh,
can
got it, got it,
revisit
got it.
that. Yeah, yeah, when
Okay,
we were going to the
cool.
website. But yes, it can be
Okay.
13,000 total. Like those were just total monthly number or
Yeah.
not total, just
Estimates.
estimates for each of the different sections. But anyways,
Great.
in this hybrid like long-term care insurance policy, it's a great way to leverage up the dollars and not be if you don't use it, you lose it kind of thing.
Yeah, if you want to go back to one more second, Bob, too, like
Yeah.
it is such a great point because again, like in our portfolio at Balance, we just don't have that type of way to guarantee things. So 200,000, you're already in the portfolio, you're already in fixed income or whatever portion. You just carve it into this. It just gives you all of that leverage. Warren Buffett has more money than most of us, and he has long-term care. And he didn't do it for the financial reasons. He did it because he knows his kids are so courteous, and if he had an incident, they would give up their lives and come over there and help him. And he didn't want them being his caretakers. He doesn't mind being care coordinators and care helpers, but he doesn't want them actually being his caretakers. So there's a lot of non-financial reasons that you're buying with this. And at the end of the day, you're really buying peace of mind. I would say out of anything you're getting with a long-term care plan, you're just buying peace of mind. It's nothing
Yep.
too sexy or anything. It's just peace of mind. All
Yep.
right. Life insurance with living benefits. Again, I don't want to spend a whole lot of time on this, but it's essentially you buy a permanent life insurance policy, and there's what's called living benefits inside of quite a few of these companies now. And what it is let's say you have $1 million life insurance policy, and all of a sudden you go into some sort of chronic situation with a debilitating disease that's terminal, then the life insurance company will let you kick into gear some of that death benefit, if not all of it, to pay out to help you with your care outcomes. So that's really what it is. And there's some other nuances around it, but it's probably the least most relevant thing to everyone on this call right now. But I'm happy to
And
chat
the
through this with
only
people.
the only thing I'll say with this one, the only reason that this I would make a consideration is the underwriting for long-term care is different than life insurance, right? So life insurance, if you have like a bad back, right? Life insurance will underwrite you because bad back isn't going to kill you. Whereas if you have a bad back and you're underwritten for long-term care insurance, they care a lot about that because that means you won't be able to move from place to place or anything like that. So depending on your underwriting circumstances, if hybrid or traditional long-term care doesn't work, something like this can provide some benefit with different underwriting standards associated with them.
Yeah, we really like these for a lot of our younger clients, like the folks
Hmm.
that are under 50 and they're still building their businesses and they have partners and spouse, young kids. We like this because stuff can happen. There can be chronic illnesses that come out of nowhere that rock a family. And so it's nice to have that peace of mind. And yeah.
Hmm. Yep.
And so
Okay.
last one here is called short-term home care. This is a newer product that's come out in the last 6 or 7 years. There's about 3 or 4 companies that underwrite this, some very reputable ones, Aetna, GTL. And so what this is I really feel like this is something that almost everyone should have. So it is a policy that only covers the first 12 months of a care event, and it's super simplified underwriting, literally 4 questions. There's an example of a person that had cancer that got approved for this because they'll still give it to you. They just won't cover the cancer treatments for 6 months. And then if you have after 6 months, if you have an outside event, like you fall and break your hip, they'll cover that. They just won't cover the pre-existing condition. So you can buy it from ages. There's a bunch of different policies, but 60 to 85 is pretty much the range. It actually is available in all states now. There's the best one I think out there isn't available in all the states. In fact, it's not available in the states that probably need it the most: California, Florida, New York, and Massachusetts. But there is another policy that's out in every state, and it's pretty inexpensive, and the pricing is anywhere from like $30 a month, and I think the most you can spend is maybe 180 a month on it. And the pricing is based on your age. So it goes up every 4 to 5 years automatically, the pricing. And there's unisex pricing, which is very good because most long-term care is really expensive for females because they live longer. But this is unisex pricing, so there's no female male pricing, and it can pay out up to about 160,000 per policy. And so where I feel this is the the most effective is that a lot of these long-term care situations are under a year as far as the need for the care. There's a lot that are over a year, and 20% are over 5 years, but quite a few are for a year. And if you have a 90-day elimination period, you're not even going to start getting money until after 90 days. This is going to start paying day one. Day one, where a doctor, same thing with long-term care, says that, yep, they need the care. You will start getting benefits right away. And I won't get too into the weeds, but it is an indemnity plan, so it just pays back, and you can use the money for whatever. You just give them some receipts and the doctor's notes, and they'll start paying. So I feel like one of the best places where this could be is whether you have a long-term care plan or not. This could be a great way to lower your costs because it's going to cover that elimination period, which allows you to go out longer, maybe 6 months or 12 months even for your long-term care elimination period, which is going to lower your costs quite a bit by having something like
Mm.
this. So, yep, it's pretty good. We can talk more about it. It's a fairly newer concept for people, but I think it really does give you the something's better than nothing. In the past, we'd say that with long-term care. Oh, you should get something that's better than nothing, like a 2-year plan. But you still got to go through underwriting. You still got to get approved. If you're medically banged up, it's just going to be really hard to
Hmm.
get and expensive. Whereas this is just a nice, easy peace of mind fix to know you have something.
Yeah, and I think that as we look at like situations for clients too, like this is an interesting way to even folks that already have a long-term care insurance policy, if they have a 90-day or 180-day elimination period, maybe something like this to fill in that 90 or 100-day, 80-day elimination period for something they already have could be a great way to just bridge that gap, so to speak. Or I don't even know if this is possible, Tim, and you might know, right? If they already have one in place, can they go back to the insurance company and like extend their elimination period to lower their premiums even while
Yeah.
it's already in force?
Yeah, they can. Oftentimes, people are forced to do that when the premiums go up. They're like, "What are
Yeah.
some things you can do? You can lengthen your elimination period." Yep,
Okay.
absolutely. So you can go back and change that and reduce your premiums, especially
And
for
the
someone
long-term
that's
care
got a
insurance
plan forever. Mm-hmm.
the long-term care insurance company would be thrilled, right? They'd be like, yeah, you want to extend the amount of time that we don't
Yeah,
have to pay while you
yeah,
have a long-term care event, like they'd be all
yep,
over it. So,
for sure.
I think this is a really interesting option. So I think next, you kind of put together a comparison here for a couple of different situations, right? One individual and
Yeah.
one couple. Which one do you want to focus on here?
We'll start. Why don't we start with Laura just to get a sense of the
Okay.
situation here? So, and Bob,
A
my
lot of
mouse, I don't
numbers,
think
so just listen to
it's a
Tim.
lot of numbers. And if I was controlling this, I'd have my mouse up top here. But essentially, we have Laura. She's a 59-year-old, healthy, working nurse. My sister Courtney, if you're on this call, I'm not talking about you, even though I think you're almost exactly this avatar here. She's a working nurse up in Boston and empty nester with 2 adult children, and she's married. And in this case, her husband already has a plan. So Laura's just out shopping to see if she should get long-term care. And Laura has $730,000 in savings. The majority is in an IRA, half a million's in an IRA, and then the rest in a brokerage account. She's almost paid off her home. And her goal is to have professional care at home, so not to be a burden on her spouse and children. Her motivation is her dad's stroke 6 years ago. So, okay, I did take this out of my family a little bit, I guess. And so the options would be self-pay on the left there. She can earmark 200,000 in today's dollars to go towards an event with 7% average growth. That's looking like around 420,000 by age 70. The risks of that, as we talked about, though, she may need those assets to live. She may need those monies to live off of if she lives really long, which we're hoping. And the IRA money's taxed when she takes that out later on. Market may pull back when funds are needed. So in this case, we're consider if she's going to self-pay, we consider purchasing a short-term care insurance policy. And also, while you're still working, we recommend maxing out your health savings account. As a family, you can put a good $6,000 into that. You can invest it in the market, and you can use those funds later on to pay for care or even pay for life and long-term care with that money. Okay, so let's go to the next one. Or she can reallocate $3,500 a year, put that towards a long-term care plan. That buys $8,400 for 3 years, or a benefit of around 342,000. So the risk to that is the premiums could increase. Now, if nothing increases till age 84, she'll pay about 90 grand for that policy. Um, One option might be to do a 10 pay. For 5,600 a year, she could pay this off in 10 years and just be done paying for it by the time she's 69 years old. We didn't add inflation to this plan just to keep costs down. One of the tricks I do is I just increase the daily benefit a lot so that your initial monthly amount is way up to 8,400, but we don't add inflation sometimes at certain ages because it's very expensive. Inflation is really where these insurance companies make their money. It can greatly change the cost of a plan.
Hmm.
Again, consider getting a short-term care policy to cover the elimination period, and that will lower her costs by about 2,300 down to 2,300 if she adds it goes out to 180 days instead of 90 days on that elimination period for a year. So the third option, which is the one I like the best here, is to reallocate 95,000 from an IRA to an asset-based long-term care plan through a 1035 exchange, so a non-taxable exchange, and then the insurance company will pay over the next 10 years the premium, and they'll get taxed each year on the premium amount. So 95,000 in, it'll probably be like 12 grand a year for 10 years they'll pay, and you'll get that 1099 for the 12 grand at the end of that next year. Hopefully that's not too confusing, but what this does is buy a really big pool of almost $7,600 a month by the time she's 79. Right away it'll be 4,200. We did add some inflation on there, but in this particular plan, it has an unlimited benefit. And
Mm.
and again, we didn't talk about this earlier, but when we're using insurance, we're using it to protect from the catastrophic, right? We're not too worried about like a couple months or a blip. We're talking like, what's the worst case scenario? And the worst case scenario would be some sort of debilitating cognitive disease that lasts for a very long time. This plan would satisfy that because it has an unlimited years of payout. And there's a couple companies that do that still. It's mind-boggling to me that they're still offering those plans, but because it could be millions that they have to pay. And then the fourth way here that Laura could protect herself is particularly at 61, she could buy a short-term care policy, helping to take care of that elimination period and give her another pool of $450 a day for 162,000 total coverage that would take care of her in the event of a short-term type thing for a year or so.
Okay.
So that's Laura. Was that okay? I don't know if that's too much for everyone to
I
take
mean,
in
it's
here.
certainly a lot.
It's a
It's
lot.
certainly a lot. What I would encourage people to do is kind of hone in on, as you hear these things, hone in on things that are like, okay, well, that may seem to make some sense, or, talk to me a little bit more about this. And after this call, or even during this call, again, please, first of all, ask questions. But second of all, follow up with us after this to make sure you get some clarification and see how it may fit for your specific situation. I know Tim did the same exact thing for like a married couple here. And as we look at it, it's really just a difference of the dollar amounts that we're using in this scenario, right? So, okay, do we want to
Mhm.
pay 10,000 a year for long-term care insurance, or do we want to do a 10 pay at 15,000 a year, right, and be done with it? Do we want to reallocate 250,000 from an IRA or set aside 400,000 to self-pay, right? Like these are all options that we can talk through that depend on other resources, personal goals, health and lifestyle questions, right? Just where you are financially with your family, age-wise, all of that. But certainly there are a lot of different ways, there are a lot of more things to think through than just, hey, should I pay for some long-term care insurance policy? So um,
That's
let's
great. Yeah, I
see.
don't really have to go into that one too much more.
We got a couple questions here, Tim. So we got a question here from Linda. Will the monthly payout of the hybrid long-term care remain at 7,600 for the length of time Laura is in a long-term care facility? That is a
Yep.
good question there. So let me go back to that. So if you just want to touch on this dollar amount here for them, Tim, how that
Yeah.
works.
Yep. So the couple things happen when you go on claim. One, your premiums stop. So if you're in a 10 pay or a life pay long-term care plan and you go on claim, you don't pay any more premium. So that I just forgot to touch on that earlier. As far as the benefit amount, wherever you're taking the care, if there's inflation on there, the inflation is going to continue to grow that benefit even while you're on claim. So if there's no inflation, or in this case, I put 3% on for 20 years to keep the costs down. There's things you can do like that. And in this case, by 79, she's got 7,600. That's it. That's what her full amount is, and that will cover in-home care or will cover care at a facility. Did
Yep.
that answer the
And
question? I
just
hope,
to
Linda. Yeah.
And just to tie into that, it depends on the policy as well, Linda, right? So this specific one is a lifetime benefit being paid out. So it would pay as long as Laura is in the long-term care facility. On this one, for example, the traditional long-term care, that's 36 months, it would only pay for 3 years that she's in the facility. So if she's in there for 3.5 years, those last 6 months would not be paid for at all through a different sort of long-term care. I will say most long-term care insurance policies are not lifetime payments.
Hmm.
They in the traditional space, they went away with lifetime payments, I think, right as I was starting to learn about all this. I want to say it was like 2011 that they got rid of the
Yeah.
lifetime pays here because the insurance companies started to realize how expensive it was going to be.
Oh yeah.
But in this specific case, this specific product, it is a lifetime payment amount. So great question, Linda. Um, and
I can
then
answer that real quick too,
hybrid.
Bob. One last thing before you jump in. I have one last thing on
Yeah.
that. You do women typically are 3.6 months, sorry, 3.6 years, and men are 2.5 years for a long-term care event. That's on average. So, you just want
Mhm.
to, if a long-term care event, sorry, long-term care plan only has 36 months of coverage at $8,400 a month. If you only need 4,000 a month, then it will obviously stretch out, but it's max. If the max amount they'll pay is 8,400 for 36 months, but you can have it for 10 years if you're only using 2,000 a month for a low key home care type thing that you need help with. I meant to touch
Yeah,
on that
and I
earlier.
think I think that point we should have had like a chart or some sort of graph or something to
I
explain
know.
that.
Yeah.
But I understand what you're saying, but I think it can be a little confusing there. But another question, Tim, with the hybrid long-term care insurance using IRA money, are there mandatory distributions involved?
Yeah. So there's no mandatory distributions once it's in the long-term care plan. If you do a one pay, that's just gonna dump all that money out of your IRA. It's a good question. I think what you're getting as like required minimum distributions, is that probably what you're getting at? There's no requirement for once it's in the plan to be paid out of that. Um,
Well,
but
and
yeah.
just to Tim tie here some of the mechanics of that one specifically. So the way it's working is you're taking, say, 95,000 in Laura's case here, and you're giving this to the insurance company, and you're saying, "Hey, insurance company XYZ, give me long-term care." What they're doing, and Tim alluded to this when he talked about it, is they're going to send you a 1099-R, because effectively they are paying the premium out of your 95,000 every year. And that in and of itself is considered a taxable distribution. So the required minimum distribution, regardless of the situation, would be covered by that mechanism of how the payment works. So again, there's some nuance there, but that was a really good question, Chuck. Thank you for asking. And is this considered assisted living or more intense care? Going back to Chuck, the first slide back here. Sorry to fly through everything, but it could be any of these, right? If it all comes down to if you cannot perform two of the six activities of daily living, whether it is in an assisted living, in a nursing home, or in home, wherever you may need it, is when long-term care would come into play. So very good question. And it all comes back to those two of the six activities of daily living.
While you're on this slide, Bob, I think that might have been where Brad was getting the question about 13K total for the in-home, because those two numbers add up to about 13K.
Oh no, yeah.
Okay.
So it's either homemaking services or home health aid. Thank you. Thank you for that. Thank you, Ryan. Gosh, it's so
Yep.
good to have smart people around you. So the first person to ask how we did after this is Ryan too, because he's just looking at all this like, what are you guys talking about? But I think you're tracking, right? So yeah, and Bob, you made a really good point earlier about the nuances of this stuff. Putting this presentation together was a nightmare because there's so much stuff we could talk about, and I know we've already lost some of you. I'm sorry, but I think what Bob said. I mean, if you've been considering this kind of planning, let us just look at it. Like Jim and Mary's situation, the traditional long-term care may actually make the most sense to them because they pay a lot in healthcare costs. And if you go down the bottom point there, there's tax deductions that the government gives you up to 6 grand if you're over 70 and 4,800 if you're under 70 for a qualified long-term care plan. So sometimes it may make sense to just get a traditional plan, pay it off in 10 years. And if you're itemizing your expenses on your tax return, you actually may get quite a big discount for doing it that way. And so
Mhm.
we'll work all that stuff out with you. Bob's the consummate planner. We're all planners here. We're all looking at this as part of your plan. And we have no specific relationship with any of these carriers. We don't go on trips. We don't go to dinners. We don't care. We're totally agnostic with what plan you end up getting. We do get paid a commission on some of these. I'll just let you know that. We'll disclose that. We're happy to disclose that. Selfishly, we'd rather just manage your money and continue to charge a fee that way and then give money to an insurance company. But we know it's the right thing oftentimes. So we'll really make sure to put this together in a very specific plan for you with all the nuances. So yeah,
Yep.
this is just a palate wetter.
Yeah, right. And Tim, you did a great job with it. And I'm going to pull up just the disclaimer slide here that we have to put in here for, from a disclaimer perspective. And because these are insurance products and they're different than investment products, and we are insurance licensed as well. So we can talk about this, commissions, all that stuff, just to be very clear there. I'm going to wrap up and go to the thank you slide. I want to, before everybody hops off or before we get any kind of wrapping it up, I want to, for next month, I'm very excited. I just broke down that we're going to be having a cybersecurity expert on with us for the March webinar. He's amazing. He travels the country talking about cybersecurity and the ways to protect your financial data, your personal data, prevent phishing scams, all kinds of things. He's going to be on with us March 27th at the same time in the evening. We're really excited to put on that webinar. It's going to be kind of like a panel discussion. So hopefully all of you that were a part of this webinar are able to make it to that one. But we'll send a lot more information out on that. So if there are more questions, please go ahead and put them in here. But just to wrap it up, I want to say thank you to everybody for being on here. Tim, thank you so much for putting all this together and being a good sport with the dual management of the
It was great.
everything there. And Brad,
Great.
you're welcome. Thank you. Thanks for being a part of it and being, engaged with all of it. But we appreciate everyone's time. We look forward to seeing you again next month, and look forward to any questions or other things that y'all may have as it relates to long-term care or any of our other, webinars we've had so far.
Yeah, thanks, Scott. Thanks, everyone. And thanks, Ryan, for helping, obviously, with all the operation stuff here, getting this thing going, and Bob, too, just for your vision to make sure we're adding value to our friends and clients. This is a big one. It's a big topic, and I appreciate everyone taking some time out here to figure this stuff out with us. So
Yep.
yeah, I think that's it. I mean, if any other questions come in, if not, I'm just gonna start rapid firing dad jokes. No, I'm kidding.
Yeah, no, we got some thank yous. Bruce, Scott, you're welcome. Thanks for being on. I hope everybody enjoyed it. I hope everybody's staying warm. Ohio's finally starting to warm up a little bit, but it's wet and gross out. So I get to fly to Dallas tomorrow for a cheer competition with my oldest. So I'll at least be somewhere a little bit warmer. So that's going to be
Bob, I'll
nice.
be there too. I'll be in Dallas this
For
weekend at
real?
a cheer comp with Georgia. Yeah, I'll see you up there.
There we go. I'll see you there, man. Look at that.
Nice.
That's
Life
amazing.
brings you together.
All right,
Awesome.
everyone.
Well, thanks everyone. Thanks for being a part of it. Appreciate the time, and we'll hopefully see you again soon.